6 months ago, energy drink Celsius's stock hit an all-time high of 99.62, only to lose 75% over the next 6 months, closing at a low of $25 only a couple weeks ago. So, has Celsius run out of gas, or is it gearing up for another moonshot? Let's dive in and find out. For those of you who want Wall Street insider analysis and access to my financial models, check out my school community, Win Like Wall Street, which you can access by going to bit.ly/WLWS for Win Like Wall Street. All right, 3 points that we are going to cover in this video. Number one, background/business model. Celsius operates in the energy drink space with the likes of Monster and Red Bull, but with a focus on being the healthier sugar-free alternative. Part two, company updates, 3Q24 results, and then also the opportunity, positives, and negatives. So the company reported poor year-over-year results in 3Q, but there is a good explanation, and it's a reason to be positive on the stock as well. With over $1 billion in revenues, a booming partnership with Pepsi, and international expansion, do these positives outweigh the negatives? I'm going to cover this in detail. Part three, valuation. On Wall Street, we build three-statement financial models culminating in a discounted cash flow or DCF valuation. I have built a three-statement model for Celsius. I can't wait to give you all the details. So let's dive in and find out. If you're enjoying this, please smash that like button. All right, part one, background/business model, company background. So what happens when a small brand challenges the giants of the energy drink world? Celsius Holdings started with a simple goal: create an energy drink that's more than just caffeine and sugar. But how did they go from a niche fitness product to a billion-dollar disruptor? Founded in 2004, Celsius launched a health-focused energy drink aimed at accelerating metabolism and burning fat. From classic sparkling drinks to stevia-sweetened options and on-the-go powders, all marketed as zero sugar and fitness-oriented. Celsius targets health-conscious consumers with a premium lifestyle energy drink, differentiating from traditional brands like Monster and Red Bull. The brand mission is aimed at fitness enthusiasts, and the Live Fit mantra positions Celsius as the choice for those who want energy but also with health benefits. Global expansion. They are expanding rapidly across North America, Europe, and Asia Pacific, and recently into Australia, New Zealand, and France. Celsius is now available in 30 countries. The brand has partnered with distribution powerhouses like Pepsi to scale its reach. Business model. So how do they make money? How did Celsius turn a simple energy drink into a $1 billion revenue machine? The answer lies in their strategic partnerships and an innovative product mix. Revenue streams. They're dominantly driven by beverage sales across retail, e-commerce, and fitness channels. International sales are growing with recent expansions in Australia, New Zealand, and Europe. We'll discuss this more next in the 3Q24 update. Distribution model. So strategic partnerships, including an exclusive distribution agreement with PepsiCo in the US and Canada. So PepsiCo's distribution has dramatically expanded Celsius's reach, enabling rapid scale, but it introduces dependency risks, with Pepsi accounting for 47% of Q3 24 revenue. E-commerce, led by Amazon, accounts for 10% of total revenue, making it a significant online player. Multi-channel strategy. Grocery stores, gyms, convenience stores, and club retailers like Costco accounted for 15% of 3Q24 revenue. Marketing strategy. So Celsius leverages influencer marketing partnerships and event sponsorships to target health-conscious consumers. Their focus on the sugar-free and fitness lifestyle consumer segment resonates with younger demographics. Celsius's strategy has been impressive, but what happens when your distributor pulls back on orders?
We don't have any Coke, but there's a Pepsi machine down the hall.
Part two, company updates, opportunity, positives, and negatives. We'll start with the latest company updates, 3Q24 results. So 6 months ago, Celsius's stock was soaring at all-time highs. Fast forward to today, it's down 75% and under $30. What caused such a dramatic shift? Revenue fell 31% to $265.7 million due to Pepsi's inventory optimization, which drove a $124 million reduction in sell-in revenue. Now, the Pepsi partnership is significant. I'm going to cover this in detail next.
Now, would you like to hear the silver lining?
Revenue from international markets grew 37% year over year, signaling potential beyond the United States. They entered Australia, New Zealand, and France with strong partnerships like Tesco and 7-Eleven. Now let's unpack some terminology because inventory optimization and sell-in revenue are a bit ambiguous. So inventory optimization refers to strategic adjustments made by distributors to streamline operations. This often involves reducing excess inventory levels in their warehouses, improving the alignment of inventory with current and forecasted retail demand, and increasing operational efficiencies with current and forecasted retail demand. Now, the future benefits are that once optimization is complete, distributors operate more efficiently, reducing the risk of overstocking and improving future purchase stability. Sell-in revenue refers to the income generated by a company from selling its products to intermediaries, such as distributors or retailers, rather than directly to end consumers. So for Celsius, sell-in revenue is recorded when products are sold to its distributors like PepsiCo, who then distribute them to retail stores, convenience shops, or online platforms. So what's the takeaway? Despite the decline in sell-in revenue, Celsius's retail sales grew 7% year over year, showing that end consumers continue to buy its product at a healthy rate. Gross margin of 46% was a decrease of 4.4% from 50.4% in 3Q23. Margin pressure from promotional allowances and distributor incentive programs will likely stabilize as optimization efforts conclude. Adjusted EBITDA of $4.4 million, down 96% from $103.6 million year over year. So while concerning, this reflects a one-time distributor adjustment rather than core operational issues. Net income of $6.4 million was a significant decline from $83.9 million year over year, reflecting the reduction in revenues without a corresponding reduction in costs. Now, having positive income amidst revenue challenges does highlight operational efficiency. Big Beverages. So they acquire Big Beverages for $75 million in cash to secure a 170,000 square foot manufacturing facility, enabling faster innovation and better cost control. This vertical integration is expected to boost innovation cycles and margins. It also adds flexibility for product launches and reduces reliance on external co-packers. You heard me mention Pepsi earlier. And with Pepsi making up almost half the company's revenues, it's critical that we understand their relationship.
Get him a Pepsi, and I'll have an icy. Mixed.
So in August 2022, Celsius and Pepsi established a strategic partnership encompassing both a significant investment and a distribution agreement. Convertible preferred stock investment. So Pepsi invested $550 million in Celsius through convertible preferred stock priced at $75 per share. This investment equated to an estimated 8.5% ownership stake in Celsius on an as-converted basis. Dividend terms. So the preferred carries a 5% annual dividend, about $27.5 million annually, providing Pepsi with regular income from its investment. Distribution agreement. So this covers both U.S. and international expansion. So in terms of the U.S., PepsiCo became Celsius's primary distribution partner in the United States, leveraging its extensive network to enhance Celsius's market presence. So top-line revenue in North America increased 2.3x from 21 to 2022, and based on 9/30 annualized numbers for 2024, it has increased 2.1x from 2022 to 2024. Global expansion. So the agreement designates PepsiCo as the preferred global distribution partner, offering opportunities for Celsius to expand internationally through PepsiCo's established channels. In the 2 years before the agreement, from 2020 to 2022, Celsius's revenue outside of North America grew at an average of 2.3% annually. In the 2 years since the agreement, from 2022 to 2024, Celsius's revenue outside of North America grew an average of 42% annually. That's a 21x increase. Needless to say, the impact of this agreement from a financial perspective has been immediate and massive for growth. Board representation. As part of the investment, PepsiCo gained the right to nominate a director to Celsius's board of directors, allowing for strategic influence and alignment between the two companies. Operational impact. So inventory adjustments had a big impact on the company over the course of 2024. So in 2024, PepsiCo undertook inventory optimization efforts, reducing its orders of Celsius products by approximately 100 to 120 million in the third quarter. This adjustment impacted Celsius's revenue, but was part of a strategic move to balance inventory levels. Now, despite these adjustments, the partnership has significantly increased Celsius's availability in retail and convenience stores, contributing to its growth in the energy drink market. So overall, the relationship between Celsius and Pepsi combines financial investment with strategic distribution, aiming to enhance Celsius's market reach and operational capabilities while providing PepsiCo with a stake in the growing energy drink sector. So every success story has its challenges. For Celsius, the road ahead has both obstacles and opportunities. What are the risks that investors need to keep an eye on? So I like the bad news first. Let's cover the negatives. High partner dependency. So, reliance on Pepsi for nearly half its revenue poses concentration risks. Disruption in this partnership could severely impact operations. Gross margin pressure. Margins declined to 46% in Q3 due to distributor incentives and freight costs. Recovery depends on resolving inventory alignment issues and distributor incentives. Competitive pressures. So, giants like Red Bull and Monster are aggressively expanding their sugar-free and functional drink offerings, intensifying competition. Operational risks. Complexities from the Big Beverages acquisition could strain resources. Legal challenges. Celsius is currently facing a securities class action lawsuit filed in the U.S. District Court for the Southern District of Florida. The lawsuit pertains to allegations that the company and certain executive officers violated federal securities laws by making false and misleading statements regarding Celsius's business prospects. The lawsuit covers individuals and entities that acquired Celsius securities between February 29th and September 4th, 2024. The outcome of the litigation remains uncertain and could have implications for the company's financial health and reputation. Stock volatility. From an all-time high 6 months ago, the stock has dropped 75% under $30, driven by slower revenue growth and market sentiment. Significant drop in the stock price reflects investor concerns about growing sustainability and competitive pressures. Analysts remain cautious, highlighting competitive threats from Red Bull and Monster's sugar-free initiatives. Now, despite the setbacks, there is a silver lining. What keeps customers coming back for Celsius, and why are some investors still bullish? Let's dive into the positives next. Strong brand and consumer appeal. So, positioned as a leader in the sugar-free, better-for-you energy drink market, retail sales growth demonstrates consumer loyalty and resilience. Resilient consumer demand. So, retail sales grew 7%, even as sell-in revenue declined. Health trends. The sugar-free movement. Now, over 50% of the energy drink market aligns perfectly with Celsius's offerings. Strategic partnerships. So the PepsiCo partnership provides massive reach, unmatched scalability, and visibility in North America. While Amazon and Costco diversify revenue streams, Amazon's e-commerce channel grew 21% year over year, reinforcing its digital dominance. Innovation pipeline. So the acquisition of Big Beverages enhances R&D capabilities for launching new flavors faster. New products, including on-the-go powders and limited-time offers, keep consumers engaged. All of this serves to keep the brand fresh and relevant. Vertical integration. The Big Beverages acquisition strengthens margins and accelerates product development. Now that we have the update and know the good, the bad, and the ugly, what do the numbers tell us? Part 3, valuation. So first thing we're going to cover is the balance sheet. So what can a company's balance sheet reveal for its future? For Celsius, it tells a tale of growing cash reserves and scaling assets to support rapid expansion. So cash and cash equivalents increased significantly in 2023 to $756 million and currently stand at $904 million as of 9/30. There's been a 17.5x growth over the last 3 years. So significant and growing cash provides optionality and allows investments like the recent $75 million Big Beverages acquisition, as well as operational investments. This strategic investment aims to strengthen long-term production capacity and innovation. Accounts receivable. In the last 2 years, accounts receivable has jumped almost 5x, with Pepsi making up 55% of accounts receivable as of 9/30. Now, the way that we analyze this is via days sales outstanding, which measures how many days it takes to collect receivables. Now, while this may seem like a concern, when we dig into the numbers, days sales outstanding average 45 days from 2017 to 2021. Since the partnership with Pepsi in 2022, over the last 2 years, it has averaged 31 days, a 31% decrease, which is phenomenal. Inventories. These have stabilized since the optimization by Pepsi, with average inventories of $192 million over the first 9 months of 2024. This optimization minimizes overstocking risk while supporting consistent sales and reflects better alignment of production with demand. Deferred revenue. So this is a liability because it signifies being paid before delivering the product or service. But it is a net positive in the case of Celsius because it shows that Pepsi is producing consistent demand for the company. Retained earnings. Now, this is awesome because it turned positive in 1Q24, and we have it increasing 9.6x in our model from 2024 to 2029, indicating a positive and growing financial future for the company. So what's the takeaway? Celsius has a clean balance sheet, and the 2022 partnership with Pepsi is showing a growing and positive impact. Let's hop in the model. All right, balance sheet. So 17.5x 3-year growth in cash, absolutely phenomenal. We covered the accounts receivable. While it's growing consistently, we don't have to be too concerned because days sales outstanding, which is the key metric, has actually declined 31%. Deferred revenue, as we talked about, shows that Pepsi is paying the company before they're actually delivering the product. Series A convertible. So this was the investment that Pepsi made in Celsius. It has a book value of 824, but the actual cash exchanged was 550 million. And then last but not least, this is a phenomenal result. Retained earnings has gone from negative to positive and will be growing significantly on a going forward basis. All right, next we have the income statements. Revenue growth. 3-year growth of 10.1x shows the impact of the Pepsi partnership. Gross margins. Now, they fell slightly due to the distributor incentives. They were 46% in 2024 versus 50% in 2023. Now, short-term pressure is manageable with vertical integration expected to restore margins. Selling and marketing. In 2022, there was a massive spike, but 181 million of this amount was due to termination of distributor agreements due to the Pepsi partnership. And part of the agreement was that Pepsi would pay the termination fees, which they did. So if we actually strip that out, the company would have had EBITDA of positive 25.1 million. Now, without the partnership, EBITDA was consistently negative, while now EBITDA margin is in the low to mid 20s with costs under control. Net income shows a 3-year growth of 21.4x versus revenue growth of 10.1x, which shows operational efficiency and cost control. Remember, revenue is what you make, net income is what you keep. So what's the takeaway? While the Pepsi partnership resulted in a rocky 2022, the benefits far outweigh the costs, making Celsius a profitable competitor in the energy drink space. Let's hop in the model. All right, so as we mentioned, 10.1x 3-year growth, that's a testament to this powerful Pepsi partnership. Again, don't be too concerned about 2022. We see this massive negative, but that was due to these distributor agreements that they had to terminate that they had in place before the Pepsi partnership. But what you see as a result of the Pepsi partnership, a massive positive inflection in EBITDA in 2023 and on a going forward basis. Last but not least, we see 3-year growth of net income of 21.4x, which is significantly higher than the 10.1x growth in revenues, which shows operational efficiency and cost control. All right, next we have the cash flow statement. Free cash flow has grown almost 44x in the last 3 years. They turned the corner in 2019, but have really increased significantly since the Pepsi partnership. Debt only consists of a small number of financial leases, so they are very underlevered. Preferred stock, while preferred dividends amount to 27.5 million moving forward, it's worth considering the benefits of the Pepsi partnership. While cash was already significant at 756 million at the end of 2023, it's projected to 2.7x to over 2 billion in 2029. So what's the takeaway? Celsius has a strong financial position with minimal debt combined with consistent and growing cash flows. This increasing cash provides it not only with operational flexibility, but also the ability to engage in transformative acquisitions. Let's hop in the model. All right, so as we mentioned, 3-year growth in free cash flow of almost 44x, which is phenomenal. Despite being a beverage company, we don't see massive growth in CapEx. They have that under control. Debt repayment is very low. These are just financial leases. We have the preferred dividends, but I think it's a small price to pay when you consider the ultimate benefits of the Pepsi partnership. And then last but not least, we see a massive increase in cash, almost 3x by the end of our model. All right, forecast drivers and DCF assumptions. The base case was run in line with Wall Street estimates of 14% top line growth. Cost of goods sold and selling and marketing were run at 2023 levels, giving no benefit of margin expansion. General administrative was run at 10%, which is 25% higher than 2023, but in line with historical levels. Now, for a beverage maker in the consumer product space, a beta of 1.85 is very high and shows the recent volatility in the stock. We used a terminal multiple of 5 times LTM revenue. That's based on the pre-COVID mid-range of 4 to 6 times and is super conservative in light of the Pepsi partnership. We're going to see this next in the DCF valuation. So what's the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. All right, so as we mentioned, we kept cost of revenue and selling and marketing consistent with 2023, though we increased G&A consistent with what it was before the Pepsi partnership. Now, in terms of top line growth, 14%, that's in line with Wall Street estimates. We have that high beta of 1.85, something to keep track of. They don't have a credit rating, but we have a 5% coupon on the preferred, so we went with that. We also have a significant amount of cash. This is something not to discount. Because of this cash, they have massive flexibility. They have almost $1 billion in cash on hand at the current moment. And then last but not least, the terminal revenue multiple. So looking at the companies that they compete with, Coke, Pepsi, National Beverage Co., etc., those companies have an average TEV to LTM revenue of 4.7x, and their average excluding high-low is 4.5x. That being said, Celsius has a much higher growth profile, and their revenue multiple since the Pepsi partnership has been pretty significant. That being said, we went with a 5 times revenue multiple to be in line with where the company was at before the Pepsi partnership, which is super conservative. All right, DCF valuation, we ran 3 scenarios, bear, base, and bull with the current model at base. Future cash flows are discounted back to today to get to TEV. We strip out net debt to get to equity value. They have high forward revenue growth, lots of cash, over $900 million, and upside potential. But is it worth buying today? The stock is down 75% in the last 6 months since achieving its all-time high back in May. Now, Wall Street has Celsius at a median of $44, which is a 59% discount. What does our analysis show? Let's hop in the model. DCF time. Woo-hoo. So we got EBITDA less DNA gives us EBIT less cash taxes gives us EBIT or NOPAT. We add back DNA. We take into account changes in operating working capital, strip out the CapEx, we get free cash flow to the firm. Don't forget our 5 times terminal revenue multiple gives us $13.1 billion on the back end. We discount all of these cash flows by the discount factor to get the present value of cash flows. We add all of those together to get our total enterprise value of about $8.6 billion. We strip out the debt, we add the cash, we strip out non-controlling interest, we add in associate investments. That gives us an intrinsic equity value of about $8.65 billion. We divide that by the shares outstanding, we get an implied share price of almost $37 a share. Compared to the current share price of $27.60, that's a 33% discount and is a screaming buy. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. 0 out of 50 or 0% showed a sell rating, 7 out of 50 or 14% showed a hold rating, and 43 out of 50 or 86% showed a buy rating. We ran each of the 3 scenarios equally weighted, got a weighted average value of $37, which is a 34% discount. So what's the takeaway? Utilizing conservative assumptions, we show a buy rating for the stock at a significant discount. Let's hop in the model. All right, so as we see in the sensitivity analysis, green everywhere, Irish eyes are smiling. We've got 86% buy rating on the stock, and these are still very conservative assumptions, especially on the terminal multiples. Last but not least, we come to our scenario analysis. Even in the bear case scenario, which is super conservative, we show the company at a significant discount, almost a buy, but then in the base and bull cases, we show significant discounts and a screaming buy rating. The weighted average of $37 shows about a 34% discount to current share price. All right, last but not least, the wrap up. So Wall Street has Celsius at a high of $62, which is a 125% discount, a median of $44, which is a 59% discount, and a low of $26, which is a 6% premium. Now, after whiffing on 3Q results, the stock is down over 75% in the last 6 months since it's reached its all-time high, but it is at a significant discount. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate, is not investment advice. That being said, I do not currently have a position in Celsius, but it is a stock I am seriously considering. Not only is Pepsi a solid partner, it's also a logical buyer of Celsius at some point, since they will will already have the distribution integrated. They have a loyal customer base, strong international growth potential, and an innovative product pipeline. Vertical integration sets the stage for margin improvement and operational efficiency. From rapid revenue growth to strategic investments, Celsius tells a compelling story, with sugar-free energy drinks making up 50% of the market. Celsius is in the perfect position to take advantage, and I'm excited to see what they do over the next few years. If you like this and want to see another in-depth stock valuation, check out my SoundHound AI model here or my super microcomputer model here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.